You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
How did we end up with two major U.S. banks collapsing in just a few days? It's a question on everyone's mind as financial markets reel from Silvergate Capital and Silicon Valley Bank's rapid downfall. Consider this. At the end of 2022, Silvergate had $6.3 billion in deposits, but Silicon Valley Bank was holding over $170 billion, a massive difference that underscores the scale of SVB's failure. Let's look at the case of SVB. Unlike previous bank failures driven by bad loans or risky investments, SVB's collapse stemmed from a classic bank-run customers withdrew $42 billion in a single day, far exceeding what the bank kept on hand. Some argue, isn't this just another symptom of poor risk management, like we saw during the 2008 crisis? But the situation is more nuanced, as these banks faced unique pressures from rising interest rates and sector-specific exposure rather than reckless lending. Going forward, the speed and interconnectedness of modern finance mean that liquidity crises can escalate with unprecedented speed, making robust risk controls and diversified client bases more critical than ever. What happens when a bank's fortunes are tied to the volatile world of cryptocurrency? Silvergate's story offers a cautionary tale for institutions specializing in high-risk sectors. In the last quarter of 2022 alone, Silvergate's customers withdrew $8 billion in crypto-linked deposits, two-thirds of its total, forcing the bank to sell $5.2 billion in assets at a $718 million loss, more than its profits from 2016 to Q3 2022 combined. Take Silvergate's fire sale. As clients pulled out funds after the FTX collapse, the bank was forced to liquidate bonds bought when rates were low, locking in steep losses and undermining its solvency almost overnight. Some might claim, Treasury bonds are safe. Couldn't Silvergate have just waited for them to mature? In theory, yes. But massive simultaneous withdrawals forced immediate asset sales at the worst possible moment, exposing the bank's vulnerability. For banks dealing with niche sectors like crypto, this episode highlights the need for liquidity buffers and diversified funding sources. Otherwise, concentration risk can turn sector downturns into existential threats. Is Silicon Valley Bank's collapse a sign of deeper cracks in the U.S. financial system, or a one-off event driven by sector-specific factors? Let's dig into why SVB was especially exposed. Nearly half of all U.S. venture-backed tech and life science companies banked with SVB, making it a cornerstone for startups. Yet 95.5% of its deposits were uninsured, well above the FDIC's 250 cap, leaving most clients vulnerable. Consider the panic that unfolded. After SVB announced a $1.8 billion loss and a planned share sale, venture capitalists urged startups to withdraw funds, triggering a modern bank run that drained a quarter of SVB's deposits in just one day. Critics might say, this could happen to any bank facing a sudden crisis of confidence. But SVB's deep concentration in tech startups, combined with rising rates and uninsured deposits, made it uniquely fragile compared to diversified giants like JP Morgan. Looking ahead, this case underscores the dangers of concentration risk and the importance of robust deposit insurance, especially for institutions serving high-growth, high-risk sectors. Will these failures spark a new financial crisis, or are they isolated events contained by swift regulatory action? That's the question echoing through boardrooms and households alike. Since these collapses, major banks like JP Morgan and Bank of America saw share declines, and regional banks faced trading halts. Yet as of December 2022, SVB still had $212 billion in assets, enough for regulators to hope most depositors will be made whole. Take the impact on the tech sector. The USDC stablecoin lost its peg after revealing exposure to SVB, and many startups suddenly lost access to vital capital, threatening payrolls and operations across Silicon Valley. Many suggest, the FDIC has handled bank failures before. Isn't this just business as usual? While true for insured deposits, the unprecedented scale of uninsured funds and sector-specific shocks make these events stand apart from routine closures. Ultimately, the fallout will shape new regulations and risk management practices, reminding us that in a hyper-connected financial world, vigilance and adaptability are essential to prevent the next crisis.